Hello everyone, welcome to Accounting 210. In this video, we will talk about chapter 12, capital budgeting, and then time value of money. So I just use my this handout. It already has a mark, but I can use this one also. I post my note to the Blackboard, so I'm not going to go through each sentence. I just want to give you a brief idea about this chapter. So make sure you read the textbook, you review the notes, you check all of the assignments, and then if you have any question, email me. Okay, so this chapter talking about one thing, right? How do you spend money? I keep saying, I say if you're a millionaire, you got $1 million, and then you want to invest in different things. You want to invest in ice cream store, you want to invest in gas station, you want to invest in a house to rent out to our students. So which project will give you the highest return, the benefits kind of? So you have to measure them, right? You cannot just say, hey, I like ice cream, so I will invest in ice cream store. So we have to think about their payback period. We have to think about accounting rate of return. We have to think about their NPV. We have to think about the internal rate of return. So we have these 4 measures. Make sure you know how to calculate each one, how to interpret each one, you know, kind of the selection criteria for each one. We first talk about payback method and the ARR. Those 2 methods, they are straightforward. They do not take care of the time value of money, so you can just use them as the initial screening just to rule out the bad investments. Okay. Payback method is straightforward, talking about how many years you will get all of your money back. So the basic formula is you use your initial investment divided by your annual net cash inflow if you have the constant cash flow. So every year you get $2,000. That's all you need to do for this class. But you know, there are other situations. You get 2,000 first year, 3,000 next year, 10,000, you know, next year kind of. If that's the situation, you cannot use this method. You cannot use this method. So you invested in 10,000, you got 2,000 every year. So it takes you 5 years to get all of your money back. That's the payback method. One thing is that it doesn't think about time value of money. The other thing is also it's just thinks about the time, not the profitability. So some projects give you the quick period to get your money back, but overall your profitability may be less than other projects. So let's think about this situation. Just think about this one quickly. You have 3 projects, then the first one give you 2,000 every year for 6 years. So your total profitability, you know, total money you got 12,000, you minus the 10,000 investment. So profit is 2,000 for this year. So this year, this one is you get 1,900 for every year for 8 years. So you got more profit overall than the first flow. And look at the third one, you got a million something, right? You got a million something at the end of the project. But if you do the payback method, the first one will give you the highest year. You just need like fastest year, just need 5 years. Second one, you need 5.26. Third, you need 5.5 year. But your total profit 30 year is the best. But if you just look at payback method, you may choose the first one, which is not correct. Okay, so that's the payback method. Second one, talking about ARR. So this is the only method focusing on operating income. So you have to focus on your operating income, not the cash. So we have to adjust from cash to our operating income by subtracting the depreciation expense from our cash flow. So our operating income is the cash minus your depreciation expense. How do you get your depreciation expense? It's your initial investment, initial cost minus the residual minus useful life of the assets, Okay, so you have to do this. So I go through this one with you. Cost is 240,000. That's your investment. That's your investment. And then equal cash flow is 60,000, 60,000, and then we minus depreciation. Depreciation is your cost 240,000 minus the residual is 0 divided by years 6. So your depreciation expense will be 60,000 minus 40,000, right? And then divided by 240,000. So this is your cash. This is your depreciation expense. So your operating income is 20,000 divided by your investment is 240,000. That gives you 8.33% as your ARR. Okay, the next thing we talk about time value of money. This is the most important part. This is the most important part in this chapter, and I will say one of the most important things in our whole class. So what's the meaning of time value of money? It's just the time has the value. Time has a value. So what's the meaning is $100 today is different from $100 next year, because you put $100 in the bank, next year you will get $100 plus the interest. So the time has its value. You should get $100 now instead of wait until one more year, because if you wait until next year, you will get 100 plus the interest, which may be $1, $2, based on the interest rate. So you cannot compare $1 now with $1 next year. You cannot compare $100 now with $100 next year. So let's say, hey, I'm earning $100 now. You will earn $100 next year. You cannot say we are the same, or you are having $100 now. I will earn 100 next year. I cannot say I'm as rich as you are. You are richer than me. $100 now worth more money than $100 next year, because it's worth almost $101, $102, kind of like that. So make sure it's always wrong to compare $100 now with $100 next year. So you either compare $100 now with $99 now, or you compare $100 next year, $100 or $101 next year. So you have to put them at the same time, either put in the present value or put them in the future value. In our class, we just focus on the present value. We focus on the present value. Okay. So you have a different tables. You have a table, let me look at the different tables. So you have a table A, table B, table C, and table D. I hope you have that one. So table A and table B, they are talking about present value, So those are the two tables you will need in this class. Table C and table D, they talk about future value. We do not do future value in our class. We don't do future value in our class. So what's the big difference of table A and table B? Table A talking about present value of $1, And then table B, if you read it, it talks about present value of annuity of $1. What's the meaning of annuity? Is every year you have the same amount of money. When you make a payment for the car, when you make a payment for your student loan, payment for the mortgage, payment for your retirement, those things, every year you pay 20,000. Every year you pay 20,000. That's the annuity. If that's the case, you need to use table B. So we have a good, actually practical example here. You are so lucky. You are thinking about you will get you won the lottery, and then you have three choices. Either you get $1 million now, so that's our present value. Present value is the money for now. You get $1 million now. It's present value of $1 million. Okay, I can take $1 million home tonight, and then or you get 150,000 for each year for next 10 years. You got 150,000 every year for 10 years. Every year, when I talk about every year, I'm hinting you that is about the annuity, right? And then, or you get 2 million, but you have to wait for 10 years. So you don't get it until 10 years from now. You have these three choices. How do you compare? You cannot say, oh, this is 2 million, this is 1 million. So I will go with 2 million. That's not correct. because your 1 million is your present value, your 2 million is 10 years later. So you have to convert this 2 million to my present value, and then you compare those two numbers. Am I right? So how do we convert? We have to use our discount tables, which are table A and table B. So you have this discount rate, and then you have the period. So instead of going back, doing the calculation later, I just go to the solution with you. The first one is you got present value of $1 million now. So that's all you need is $1 million now. And second option is you got 150,000 every year for 10 years. You got 150,000 every year for 10 years. So that's the annuity. And we look at our annuity table. We said, look at this. How do you get a number, right? 8%, and then for 10 years. So look at our table B. 8% for 10 years. 8% for 10 years. Our discount factor is 6.71. That's all you need. That's all you need. So you use your cash flow 150,000 time the discount factor you got based on 8% and 10 years, 6.71, 6.71. You get your present value of all of the 10 times of the payment, 150,000 every year. So instead of waiting, for 10 years, every year you got 150,000, it's the same as you get 1,006,500. It's the same. They are the same amount of money. This is the present value of all of your future cash flows. How did we get it? It's your cash flow every year times the discount factor. How do you get discount factor? You go to annuity, you look at 6%, 10 years, you get that discount factor. The last one is you got 2 million, but you have to wait for 10 years. So it's just one time, right? You don't get 2 million every year. So it's not an annuity. You just get 2 million at the end of the 10th year. So in that situation, you go to our table A, you use discount factor of $1. And then 8%, you wait for 10 years, you get the discount factor is 0.463. 0.463. So you use your 2 million times your discount factor 0.463. You get the present value is less than $1 million. So now you can compare the apple with the apple. First choice is you get $1 million now. Second is the present value will be more than $1 million. The third choice is the present value of 2 million after 10 years is less than $1 million. So you should go with the second choice because the present value is the biggest amount. Okay, so that's stop here a little bit. I want you to get the idea of how do we convert, how do we discount all the future cash flow to our present. Okay, next one, once you got that idea, we go to the most important thing called net present value. So it uses the discount cash flow, it uses the discount cash flow. And then we said payback and the ARR, they don't think about time value of money. IRR and the NPV think about time value of money. We said the first one is net present value. What's the meaning of net present value? So it's always, it is your net present value. So you first get your present value. Second is you net the cash inflow and the cash outflow to get the net present value. Okay, so you have two choices. Either you go to smartphone or you go to speaker. So for smartphone, every year you have the same amount of the cash flow. Speaker, every year they're different. So for us, for this one, you can use the annuity. For speaker, you have to do each year, discount them back by each year. And then you both spend $1 million. So that's your investment. What's the meaning? Investment is your cash outflow. Investment is your cash outflow. Is you spend money, right? You spend money. So the general idea is draw a line for smartphone. Is at the beginning of the project, t equals to 0, you spend $1 million as outflow. And then t equals to 1, t equals to 2, t equals to 3, t equals to 4, t equals to 5. You got the 305, 450 for each year. And then what do? Is you have to discount. You have to first get the present value, right? You have to first get the present value. So we have to discount all of this future cash flow to our present. Remember, it's kind of like your the payment, your payment of your lottery. Every year you get some money. So we have to discount. How do we get discount? We look at the annuity, right? Remember, we look at our annuity table. Rate is 14%, and then 5 years. Rate is 14%, 5 years. So we look at our annuity, 14%, 5 years. Discount factor 3.433, 3.433. So it's your 3.433 times your every year cash flow 305, 450. So your your present value of all of your cash inflow is $1,048,610. So that is your present value. This is your present value. And now you need to net your inflow with your outflow. You will get $1,048,610, but you have to spend $1 million to get that much. So your net present value, your NPV is $48,610. Should we invest? Yes, because overall we still get almost $50,000, right? Over 5 years, the net present value is positive, so we should go ahead and do it. That's our first smartphone project. We look at our speaker. You found out that every year there are different cash flows. So you cannot use the table B. You cannot use annuity. It's not annuity. You have to discount every year individually. So I'm not going to do it. I just get all the number with you. So we have to go to table A. 14%. Then for the first year is 0.877 discount factor. Second year 0.769, you times the related cash flow. Third year 0.675 times cash flow on that year. Fourth year 0.592 times that year cash flow. Last year 0.519 times that last year cash flow 40,000. So you get your discounted present value for each year. You add them, that gives you total present value of net cash inflow of your cash inflow. You subtract of your outflow. So you get your net present value. Which is 78,910. Right. Okay. So that is all our NPV with no residual. We just say, hey, at the end of the year, you got all these present value. So suppose now at the end of the project, you will get the residual. Remember that example, this example, I go through this one more time. Sorry. So you spend at the beginning, you spend $1 million, and then every year equals to 2, t equals to 3, t equals to 4, t equals to 5. So every year is 305, 450, 305, 450, 305, 450. Okay, So every year you get the same cash flow, 305 or 450. But at the end of the year, you have a one-time extra cash flow. Only at the end of the year, you get extra 100,000. So only for year 5, only for year 5, only for year 5. Sorry, I cannot emphasize this enough. You only get this 100,000 for year 5. So how do I get the NPV? So 2 steps. First one is you discount all of the annuity, right? You discount all of the annuity. Second is you discount that 100,000. Then you discount that 100,000. You discount that 100,000 separately. For the annuity, we look at that, we found out the discount factor is 3.433, 3.433. For the extra 100,000, 14%, 5 years. Remember, 14%, 5 years. Discount factor is 0.519. So you just discount that 100,000 by itself using table A with the discount factor. So this is the present value of your annuity. This is the present value of your annuity. This is the present value of that 100,000. So your total present value of your future cash inflow is 1,1,510. You invested 1 million, so your NPV is 100,510. Okay, so that's all about NPV. Last thing is talking about IRR. We said IRR is just the rate for that project that makes the NPV equals to 0. So you need to figure out how do we get our internal rate of return for that project. Remember, for our smartphone, we said NPV is positive, but we don't know, hey, what is the smartphone-based project return? What is the return for the speaker? So we have to figure out their internal, this individual project rate of return. We call it internal rate of return. How do we calculate? This is the rate that makes your NPV equals to 0. So I'll first write down my NPV is 0. My NPV is my cash outflow, which is the investment, time the cash inflow for every year, and then time the discount factor. In this situation, I don't know the discount factor for this individual project because I don't know the rate. I need to find the rate, right? But I know this NPV has to be 0. So I found out my discount factor has to be 3.274. 3.274. And now I look at my annuity table. For 5 years. So I first look at 5 years. I want to find the discount factor at 3.274 in 5 years. In 5 years, 3.274. I got this discount factor, 3.274, 5 years. I look up, okay, you look up, you found out the rate is 16%. The rate is 16%. That is the IRR. This is the IRR. Remember, your required return is 14%, but you got 16%. So that's you are doing much better, right? You borrow money from the bank, interest is 14%, but you generated 16%. So you are doing better. So that's the reason we should go ahead to invest because we are getting higher return. This is how do you get the IRR. IRR is you have to look at the table. You have to look up to find the return. Okay, so this is basically all about our lecture. I think there are something I want to discuss with you. We did this in class. Something I'll go from the last page, page 12, from the easy one. One situation is in your problem, you may find out that you cannot exactly find those rates. For our example, we found it's exactly 16%, but I put my solution there. If you are in class, you should know what I'm talking about. If you are not in class, make sure you ask your classmates. So this asking about your IRR. In the assignment, you may not get the exact number. For this one, you say you get the NPV equals to 0. You found out that the factor is 4.661, and then we said it's 7 years. So if you look at the 7 years, 4.661. You don't find 4.661, you found out it should be around 4.564 and 4.868, right? You want to get 4.661, but you don't know, so it's between 10% to 12%. It's between 10% to 12%. So I didn't really try my accounting lab. I promise you in the exam, I will give you exact number, so you should be exactly find the percentage in the exam. So let me know if my accounting lab has just the range. Just let me know so we can figure out the points together. And then if you go to page 11, this one talking about the NPV. So NPV, I don't really have much to say. I think you are all good at that one. So it's your initial investment outflow plus all of the inflow. So you net those two things, you get a net present value. What I'll try to tell you is what is the maximum number of the price to pay for this project. Okay, so what's the maximum number? For the first project, you will generate $293,112. You will generate this much, $293.112. Let me ask you, what is the maximum cost you want to pay to get this benefit? Do you want to pay $293,113 to get $293,112? I'm not an idiot, right? I'm not going to pay more. I'm not going to pay a cent more than this money I will get. Our maximum I pay is just exactly the money I will get. Am I right? You will get $1. Maximum I pay is $1. It's really not right if you get $1, but you pay $2, right? So you get $1. Maximum you can pay is just $1. So you pay is just how much present value you will get from this project, which is $293,112. Second one is the same. You will get $380,768. That's how much you will get. That will be exactly how much I will pay at my highest price. I'm not going to pay $3,769. I'm not going to pay a penny more. I get $1. I will just pay $1. So the maximum I pay is $380,768. Okay, this I shouldn't call him not smart, right? He paid $190,000 to get $180,786. So he lost $9,232. That's not right. The maximum number you won't pay is the money you will get. The money you will get. Okay, so that's how you get the maximum price to for the project. And then if you go to page 9, you have a similar question in the My Accounting Lab. So it's asking you about the annual cash flow. You have to calculate the annual cash flow by yourself. You read this question first by yourself, right? You will get extra money 243, but you have to pay 145. So for each skier, your contribution margin is increased by $98. And you will have 123 skiers every day, and then you have 163 days every year. So that will be your annual cash inflow from this project. And then how do we get our operating income? We said operating income is your cash adjusted for depreciation expense. So cash is that much money we will get. How do we get the depreciation expense? Depreciation expense is the cost, 8 million minus residual 900,000 divided by your years is 80 years. So you get your depreciation expense. Okay, so that's all I want to say in this handout. And then let me know if you have any question. Practice all the assignments. Chapter 12 is very important. It's also very useful for your daily life. Remember, you never know. Maybe one day you will win $1 million lottery. You know, call me if you get that lottery. Okay, bye. Thank you.